Home prices increased for the first time in 6 months in the month of February, all while the Bank of Canada held rates at 5%. And these 5% rates are causing an increase in the mortgage arrears out there across the country. And the amount of corporate bankruptcies that are happening are absolutely shocking. In today's episode, we're going to dive into all of these, plus share the key points from the February Vancouver real estate stats that have just come out. Now, if you are considering selling in what is now an upward trending market, well, the strategies, they do shift from what we've experienced over the past 6 months or so. And so we've created an in-depth guide on how to prepare your home so that you can figure out how to sell for the highest price.
Get one chance to sell your home. And by doing a few fundamental improvements to your property, you can sell for top dollar, providing you the most amount of money for your next home, or even better, a new home and some money for the other great things in life. The guide is absolutely free. So to get your copy, go to thevancouverlife.com/top dollar.
So let's start today's episode off talking about the Bank of Canada and the interest rates, because of course, hard to miss this one, but they maintained their overnight rate this week at 5%. This was expected. Most of the markets, most of the votes were in, and they did not expect any movement from the BOC, and those that voted that way were obviously correct. Now, the bank did note that economic growth is slow, wage pressures are easing, and the economy overall appears to be in a modest excess supply, a state of modest excess supply. Understandably, shelter, those costs remain the largest contributor to the inflation CPI basket. Now, the Bank of Canada, they expect headline CPI inflation to remain close to this 3% range where it is now in at least the first half of 2024 before gradually falling back to its 2% target. Now, according to the BOC, although the economy has been flirting with a recession, both in 2023 and right now, it has so far managed to avoid a lengthy contraction in output. Okay, this is somewhat subjective that we'll dive into, but this is their stance and their public press release here. Now, that said, too, there are a lot of underlying and severe issues that we're going to get into that the BOC really need to consider when they're making their next rate announcement in April. Now, overall, again, this press release, this commentary from Tiff Macklem was somewhat dovish. Like I talked about earlier, right? There are signs of wage pressures that may be easing. So where are we now? What do the markets expect? Well, markets are currently pricing in 3 rate cuts within 2024, 0.75% of cuts total. But will that be enough when you start to look at certain data points? Remember, the BOC was very late to the game when it came time to rise, when inflation was spiking and they were holding very low. And we are of the belief that they will likely be late to the game when it comes time to cut. And maybe they won't be cutting as deep as they should. Understandably, all attention now shifts to the April 10th date. Put that one in your calendar because that is the next date that Tiff Macklem and the Bank of Canada meet. And that is the first one where the next rate cut, as of right now, is very much a real possibility.
I mean, when you start to really look at businesses here, especially when you look at insolvency data, this is where it gets really bad. Business insolvencies spiked in January to a level not seen since 2006. And if we look specifically at corporate bankruptcies, the numbers are literally off the charts. Monthly bankruptcies are as high as 570 per month. For reference, the long-term average is 170 a month. With that, many companies going out of business, the employment levels are certainly next to get hit. Private sector payrolls have trended down for the last 6 months, and for the first time since the COVID lockdowns. And prior to that, it was the global financial crisis. This is a major recession signal. Plus, per capita GDP, which we know has been dropping, has continued to see now 5 straight quarters of negative growth. Plus, we're seeing it fall at an annual rate that has always precluded a recession. It's definitely storm clouds in the making here.
We're also, of course, seeing this in the mortgage delinquencies or the mortgage arrears rate as well. 2 years into a rate hiking cycle, and We are really starting to kind of see the cracks with people who are late in paying their mortgages to the tune of 3+ months is what is considered in arrears. Last month it rose. Nationally, we are now at 0.18% of the 5+ million mortgages across the country are in arrears. This is off the 2022 all-time low of 0.14%. Yes, that is up 28%, which does sound dramatic. And realistically here, that 1% or 0.01% increase we saw last month nationally, well, that equates to 500 mortgages across the country that were added to this arrears list. Yes, I just said it's 0.18 total. For context, let's keep in mind though, pre-COVID 2020, that same arrears rate was at 0.25%. So we're still fairly well below where we were just 4 years ago. But this is unquestionably becoming an area to watch and to watch closely. Because a 1 month 500 mortgage increase to this list is the largest single month increase we've seen dating back to 2020 over COVID. And before that, we have to go all the way back to 2011. So the high rates are really starting to affect the sector, understandably. I think it's taken a lot longer than a lot of people expected, especially considering we're only at that 0.18% today. Clearly, even though it is increasing, we have not seen any cause for people to basically list their properties and vacate en masse, at least definitely not in Vancouver. And we're going to get right into those stats now. So let's go over it. February 2024 numbers. As always, we start off with the total sales volumes. And if you remember, we are coming off a 39% increase spike in sales from January year over year. Well, February did increase as well, up 14% from the year before, and a noticeable 45% increase month over month. How does that all look when it comes to actual numbers? Well, last month registered 2,070 homes sold. Doesn't sound that high, but you know what? It's the highest amount of homes sold dating back to August of 2023. And as realtors out there every single day, you felt it. Every open house you went to, there was, the essential shoes outside the front door. There were lineups at some of them. They were packed inside. We've personally, as a team, dealt with more multiple offers in the last month than probably the 5 months previous to that. The phone is going off nonstop, and our lovely 16-hour days are back. It's interesting to see that essentially Vancouver, the real estate market, it feels like it can turn on a dime. And in 2024, that dime turned upwards, and that happened in February. Just like last year, in October, it basically dropped off overnight, it felt like. What's remarkable is, though, even with these large jump in sales numbers that we're sharing here today, February sales were still 23% below that 10-year average. So for reference, things are still pretty slow. A large part of the heightened activity that we're talking about, ultimately, it's around a smaller section of homes as inventory is still very low. This kind of creates a superficial feeling of a hyperactive market because you go out and everything you see is active, but again, it's active in a smaller segment of the market. So it's clearly one that is trending upwards, and we are going to be sharing all this information as it unfolds with you.
Yeah, I'll get into new listings in a sec, but Dan, you made a really good point that I just wanted to elaborate on. When you said the market feels like it can turn on a dime, and I completely agree with that. And that, I believe, is due to the fact that we have such low supply, that we have such excess demand for the product types that are available. And as such, it doesn't take a whole lot of movement to feel like the market will shift because there's such small amounts of inventory to deal with. So, and we'll get into this when we touch on price. We've got a very interesting story, or a couple of stories to touch on anecdotally to speak to this. But when you don't have a large data sample, when you have a small data sample, any kind of movement up or down is going to get felt throughout the marketplace. And I think that that's really noticeable in today's spring market. Anyhow, getting on to new listings here. 4,560 new listings. That's a 31% increase year over year, a 21% increase month over month, and that's right at the 10-year average. So sales are low, new listings are on par with average, increasing inventory, right?
I mean, that's what the math would suggest. So let's dive into that. So after we saw inventory actually drop from January to February, which if you watched last month's episode, that's the first time that has ever happened in our recorded history. Well, inventory did increase in February, but only by 6%. At the end of the month, active inventory washed out under 9,200 active listings. Still, that's about 11% higher than where we were this time last year. But this is a very interesting data point here. Active inventory right now is 0.3% above the 10-year average. We're higher than it's been for 10 years. Well, interesting, because I didn't believe this at first, to be honest, because we're out there every day and it's very hard for our buyers to find homes they like. You know, you're trying to put together these tours and there's only a handful typically that are available. But anyway, check the data and yes, it's true. And this is largely, of course, because, well, let's go back. What happened in the last 10 years? If you were in the industry or paying attention to what was going on in this era, 2016, 2017, 2018 was incredibly low inventory with huge sales volumes and the previous blow off top, right? Prior to, of course, all those taxes that came in before all the foreign buyer taxes and bans and whatnot. And then, of course, COVID, you know, we know what happened there too, from 2021 basically to today, also very low inventory environments. So this sub 10,000 active unit inventory landscape that we've been talking about for maybe a couple of years now, it's actually becoming the norm, right? Today at above average active inventory is normal, I guess. Now, we did have a video where we discussed the potential of having low inventory forever. That was the title, low inventory forever. I think it had a question mark on it. And here we are. This looks to have come true just a couple years later. And let's be honest, this is not an attractive environment for buyers. You know, I hate saying it, but all the buyers that we shop with, they are often shocked at how few options they have. And then, of course, the ones they like, well, either they're already under contract, they've actually sold, or guess what? You are competing. So let's go. Now, even with increased interest rates for 2 years, we're at 2 years now of this rate hiking cycle. We have not seen this flood of inventory hitting the market. In fact, the opposite has happened and people are really holding tight to their homes. And as of right now, there's no sign of this changing.
And remember, markets tend to take the path of the most pain. And here we are. You know, it's interesting when you add a flood of money to the economy and then you open up the gates and you allow a ton of people to come into the country and you don't help builders during a high interest rate environment or developers during a high interest rate environment. You don't provide enough incentive or enough borrowing power for them to add supply while demand gets pushed down. We're just kicking the can further down the road. And here we are again. And it's, in my view, it's only going to get worse. We talked about it on our last podcast, how building permits are at all-time lows. So it's going to take a long time for some kind of reform before we really see some more inventory take place. We'll see with the multiplex plan. Anyhow, moving into the sales to active ratio, this is a good temperature check on the sentiment in the marketplace. Big jump, up 65 from last month to 23%. Sorry, up 6%, not 65, up 6% to 23%, and now into a seller's market for the first time in 5 months. That's not surprising, generally speaking, considering all of the factors at play here. If you don't like a competitive market, I really hope that you were out there over the last 5 months trying to find that property, because the rest of the spring is trending towards a seller's market and trending up quickly. The jumps are quite significant, and it's going to become more challenging for buyers and sellers that will be buyers as well. So when you look at detached homes, for example, we were sitting comfortably in a bit of a buyer's market there for the last little while. But last month alone, that jumped up 4% to 15%. We're now at 31% for townhomes. This is up 7%. And apartments are up to 27%. That's 8% higher than last month. I mean, I'm not the only realtor who I've spoken, or Dan that I've spoken to, who has looked at property that's been sitting on the market for the last 30, 40, 50, 60 days, only to then end up in multiple offers on day 62. It's just a function of having very tight inventory and also very sort of average quality. So when you see really nice property coming onto the marketplace, it is getting competed for.
Absolutely. That's that kind of turn on a dime sentiment that we talked about, where, yeah, it's a bit bizarre sometimes as a realtor to call, hey, what do you mean, 2 months on market and now you have 3 offers? It happens all the time. It's really quite fascinating. And it goes to show that, hey, the ones that weren't interesting 2 months ago are actually really interesting today. But you know what else is interesting is what is going on with prices. Because after lowering for 6 straight months, the HPI increased during the month of February. And not a small amount. We're talking 1.9% in 1 month. That is big. It's big going up. It's big going down. It is actually remarkable. I mean, if that were to persist for a year, you'd have a 22% year at 1.9% per month. So again, we're 2 years into this rate hiking cycle, and the resilience of the Vancouver market is showing itself once again. All the issues we just discussed earlier, people are now losing their jobs. The corporate bankruptcies are spiking. Arrears rates are increasing dramatically, up 28%. And yet, wait, home prices are going up? This is very unusual. Well, let's dive deeper. What's going on here and what are the actual numbers? Well, HPI, that number, the average home now, $1,183,000. That's up 22 grand from just last month. And we're up year over year still, 4.5% higher than we were 1 year ago. And if you want to pull back and say, okay, well, it's been down for a while, how are we looking compared to that blow off top in 2022? We're only 6.5% below where we were in 2022. And here is a fascinating stat, When we dissect that and just go down to condos only, looking at the HPI, condo prices are less than 1% below peak 2022 prices. I mean, I had to triple check that. It doesn't sound logical. It doesn't make sense. How are we seeing similar prices from 2 years ago when the overnight rate was 0.25, when people were getting mortgages at 1.5%? And all of a sudden today, your same mortgage for that same condo is 6%. And yet the prices are the same. I mean, don't get me wrong, they dropped. Condo prices dropped 9% from those highs, but they have been clawing their way back and are now within 0.7% within peak prices. This is at 5% interest rate. This is with 35, 40% less buying power in the marketplace. And here we are, resilient.
Yeah, I've even got a story to kind of anecdotally add to that. We had a very nice listing in Mount Pleasant here. It was a beautiful loft condo. We listed it on Tuesday and we started showing the property Thursday and Saturday and Sunday. And in those 3 days, we had 40 showings for that one apartment. We generated 5 offers and it sold nearly $50,000 over the list price. We also generated a backup offer that nearly got into a multiple backup offer scenario as well. The sentiment around condos, probably due to the affordability issue, is why we're seeing such a huge, I guess, interest or level of competition there, especially for nice product. The same to be true on the detached side of things. Was involved on the purchase side here. We were in Grandview Woodlands, 112-year-old home, very imperfect in many ways. Also found ourselves in multiple offers with that one selling $40,000 over the list price, which is just crazy. It's just crazy.
Yeah, and for reference to that, the condo that Ryan was talking about, list price was like $749, to give you an example of sort of the interest levels at that price point. And then, okay, so let's talk more about price point, because we also like to dissect this and share the median price and the average price, because that was HPI discussed earlier. So what did median do? Median went up $22,000, now sitting at $960K. That is a whopping 4% under peak prices. And average also saw an increase. Average home prices went up $27,000 last month alone. Second month of increases for that metric, up $40,000 in 2 months. They're starting to feel like I'm repeating 2021 kind of data here, which is completely uncanny and bizarre. Anyway, average home price is now sitting at $1,279,000. And, at this point, you have to shake your head and ask yourself, what can it possibly take to significantly lower home prices in GVRD? I mean, I'm not going to list them again, but we go through the 9 taxes that have been added in the last 8 years, all the bans, et cetera, et cetera. And here we are with condos basically at all-time high prices, for example. So what's it going to take? And well, I don't know. I'll give you one hint. It's not taxing the demand. That's for sure.
Or another tax at all, for that matter. But with that being said, looking at days on market too, it's dropping like a stone. We were at 31 last month. We're down to 14. That is a 17-point drop in that month alone. That's turning on a dime, for lack of a better term. Many listings now are holding offers. The vast majority of detached listings that we're seeing are also holding offers. We're seeing a lot of townhomes and duplexes holding as well. It's just, and we're also starting to see that strategy of sellers listing below assessed values or listing quite low in order to generate that buzz. So we're definitely seeing that strategy getting deployed again.
I forget where the term turning on a dime comes from. I think it's a car reference, but I don't remember exactly. I don't know. If somebody remembers where that phrase originated, please share that with us. But moving forward here, yeah, so that's the stats, that's the numbers. And somehow, basically every metric we just discussed is on the way up. Sure, 1 month does not make a trend, but I can tell you as we are going into the spring market, there is no question activity levels are going to continue to increase. We've got the crystal ball from our mortgage specialists that all tell us that essentially, the last month has been incredibly active for them. So we know that home buying follows that. We know the warmer temperatures bring people out. And again, we know just by sheer amount of phone calls and emails in the inbox, this is how things trend. So we're in a very almost typical cycle now, right? Potentially the COVID cycles that basically didn't exist. It was just one straight line up and to the right is now kind of gone. I think we've settled in and we can expect a busy spring, a slow summer, a busy fall, a slow winter. That's kind of what we're going to see as far as activity levels goes. But let's give you a bit of insight as much as we can as to what to expect if you are buying or selling it in the next 3, 4, 5, 6 months or so. It kind of feels right now that, look, the market has stopped waiting for cuts. People are back, right? The activity levels are up. Yeah, sure, we're below historic norms. But again, there's enough people that have been maybe watching the market for a year and a half and going, okay, well, 5% overnight rate is the norm. And that's what I'm going to buy in. And I'm going to buy what I can afford. And they're going to do so in a continuing tight inventory market. We're seeing stuff come to market, but we're seeing it get absorbed very quickly, as we discussed ad nauseum here. The good ones do sell fast. So right now, it kind of feels like the spring of 2023 all over again. I think we're going to see a nice little spike here. Nice if you're looking for increased levels. It's interesting to see. Again, yes, it's 1 month, but interesting to see prices rise ahead of any kind of rate cut, right? So many realtors or so many people think that, sure, that rate cut will bring everyone back to the market, but they're kind of jumping ahead of it. And they're going to buy regardless where the rates are. They're going to buy regardless how many taxes are in place. It's not a beautiful marketplace, that's for sure. But those that would prefer home ownership over renting or staying with mom and dad, they're seriously looking right now.
I wonder too if people have learned some lessons from the COVID era, in so much as that we learned a lot when rates dropped and dropped to where they did. Now I'm not suggesting rates are going to drop there again, but I think people understand that it's liquidity that moves a marketplace, and as the Bank of Canada and the federal and then the feds down south look to increase liquidity later in the year, that is the main driver of asset price increasing. So, I think a lot of people have learned some lessons here and are getting ahead of that. And I think we're starting to see that they would way rather pay maybe a little bit higher interest rate over the short run as asset prices continue to drive north if credit becomes more available, which all points suggest it will. I mean, when you look at even investment houses, last week I was fortunate enough to go to Nicola Wealth's 2024 economic outlook. They're not buying what the Bank of Canada is putting out. They're suggesting there's much bigger problems in the economy, and or that the BOC is even aware of. And so they're looking to they're suggesting that the Bank of Canada is going to be forced to cut rates, and potentially more so than they're suggesting. And those are some of the underlying problems that we've mentioned in this podcast. I mean, when you consider the fact that corporate insolvencies are rising at the pace that they are, and unemployment numbers are going to get worse, the way you correct that is by allowing businesses to have more money to spend and hire again to bring these people back to the workforce. Though we're not there yet, I suspect we will be. And the question is it a soft landing? Probably not. In Canada, we're probably going to see more of a harder landing. And that means potentially deeper rate cuts than expected. Remember, too, that the housing cycle typically leads the business cycle. So when you start to see the housing market move up, the business cycle will tend to follow. The feds are also going to be slashing immigration numbers and temporary work permits. And when they do that, this will further crater our already faltering GDP numbers, especially the GDP per capita numbers. It could see us move into a formal recession, and then again, an even bigger narrative to cut rates. So it's my opinion that you would take what you're hearing from the Bank of Canada with a grain of salt. Take a look around you. Look at your business that you're working in, or look at the company that you're in. Are they cutting jobs? Are they getting leaner? Are they buying as much as they were? Are they taking the same risks? Chances are they aren't. Don't always take the words from the ivory towers as gospel. It's not. They've been wrong before, and they're likely going to be wrong again. And that's because they typically look at lagging indicators when they make forward decisions, which is backwards. They should be looking at forward indicators to make decisions going forward, but they don't. They look in the rearview mirror, and what they see in the rearview mirror guides them for where they're headed. And that's not always the best case scenario. We find ourselves in a roller coaster when we do this. And it's possible that in the coming months, maybe the next year, we're going to see much deeper rate cuts than they're currently talking about.
We certainly have a number of trusted advisors now hinting or suggesting as much as 150 basis points is what they expect to see as far as the cuts go in 2024. Time will tell, of course, but stay safe out there. Don't overextend yourself. And as always, thank you so much for tuning in. We look forward to connecting with you again next week. Bye.